So let's shift gears a little bit. We've been talking about spending. Last week we talked about the inflow side, the revenue side. So let's talk about the difference between revenues and spending, or surpluses and deficits, uh, those things that are the aggregate change in financial position from year to year. Um, if you've read that section of the analyst guide, then you know that I've made this point that not all surpluses and deficits are created alike, and you need to be careful not to just assume that a deficit is a bad thing, uh, or that a surplus is a good thing. A surplus may indicate that they're not spending everything that they ought to be spending to provide service, and a deficit, may be a timing thing, that they had resources come in the previous year that were meant to be used in the current year, so it made it look like there was a big surplus last year and a big deficit this year, but it really was just a matter of timing. You need to look into that to understand what's going on there. But surpluses and deficits certainly are red flags that you can use to indicate areas that you need to look a little bit further. Overall, you're indicating here whether the revenues are sufficient to cover the costs of operations. Right? Surpluses and deficits, those terms more often used when talking about governmental fund reporting, whereas when you're looking at accrual-based reporting and the other financial statements, you're talking about change in net position. Um, you know, if those revenues aren't sufficient to cover the expenses or the expenditures, how's the government making do? How does it survive year to year? Because you can't keep generating deficits year after year after year. There's no way you can survive doing that. So you've got to get those resources from someplace else. Maybe it's transfers within the government from one activity to another. Maybe it's a reliance on one-time actions or one-shots, as my former organization, the Citizens Budget Commission in New York City, helped to popularize that term, one-shot actions. So surplus and deficit, the key thing in the governmental fund statement of revenues, expenditures, and changes in fund balances is the excess or deficiency of revenues over expenditures. Here, I think you just want to look at the general fund and the special revenue funds. Those are your operating funds. You don't want to look at capital projects funds, although it's interesting, I mean, in terms of financial performance. These can be very misleading. Here's an enormous capital outlay in this year, but there wasn't much in the way of resource inflows. I think perhaps if you had looked in the previous year, you might have seen that there was, a significant inflow, maybe proceeds here of long-term debt that was issued, and so it was issued in the previous year, and then it was spent in the current year. So the previous year would have looked like it had a gigantic surplus, and you shouldn't, start looking for things to spend that money on, because it's just, they haven't actually had to pay the construction costs yet. And then the following year rolls around, they pay those construction costs. The inflow isn't there. It was the year before. Now it looks like they've got a gigantic deficit. You might also want to look into if the major funds, if the non-major funds, or as they might be called, other governmental funds, are significant. You might want to take a look in there and see if any of those are special revenue funds, as opposed to debt service or capital projects funds. Obviously, the debt service funds are in here. You can see the interest and principal repayments. A significant portion of this total expenditure is capital outlay as well. Public works, this may be operating or it may be capital. You won't know until you look at the combining statement that shows the individual non-major funds. And then you're going to want to look at these other items. So now you've seen here that, these operating funds, in fact, are running deficits. So how do they make ends meet for the year? And you can look at transfers. As it just so happens, the general fund, it has this deficit here of revenues over expenditures, and it's also a net transfer out. Transferred in $129,000, it transferred out $2,163,000. This is where that note disclosure of interfund transfers can be very useful to see where they're flowing. It's not always completely clear here because you only have certain funds that are shown individually. The rest are all aggregated. Plus, you don't know which fund this 2,163,000 went to. It probably went to several different funds. So that note disclosure that shows you where the flows are going can be very useful. You see here, if you look, here's the non-major funds are a major transfer in net, and that's not surprising. Probably a lot of that went to debt service. It's often going to be the case that that's going to be property taxes, so they're raised and recognized in the general fund, and then they're transferred over to the debt service fund. You're also going to look to see if there are any special items or extraordinary items. Are they selling capital assets in order to make ends meet? They do that, and they still overall have a decrease in fund balance of over $1 million. You're also going to want to take a look at budgets, and I'll spend a little time now reviewing budgetary comparison schedules, or as some governments may present them as a basic financial statement, a budgetary comparison statement. But a lot of the valuable budgetary information obviously isn't going to be in the CAFR, it's going to be in the budget. So you're going to need to look at government budgets to get a sense of what's going on there. And I'll say a little bit more about this in a few slides, but that's going to tell you about where things are going looking forward. The CAFR is entirely historical information, and looking at the current budget and future budget plans will give you a sense of where the government is heading from here. Now, the budgetary to actual comparison schedule is encouraged to be presented as required supplementary information, or RSI, but governments have the option to present it as a basic financial statement. That obviously is going to have some impact in terms of audit coverage, but I wouldn't in any sense feel less reliant on a budgetary comparison schedule presented as RSI than I would if it were presented as a statement. I still think that information is going to be highly reliable. So here's what one might look like. The three required components are the original budget, the final budget, and the actual amounts on a budgetary basis. Plus, what you don't see here is the reconciliation of the actual amounts on a budgetary basis to the actual amounts on a GAAP basis, the numbers as they're presented in the governmental funds. The variance columns are not required, but it's very simple to calculate the variances on their own, and I'll show you in a minute how to do that. This presentation shows original to final and then final to actual, but another one that might be important, in which actually I would care more about, would be to add these two together and get the original budget to what actually happened. So you're going from the very start of the process to the very end of the process and seeing how they changed over time. And then once you identify what changed significantly, then you need to go and get answers why. Was it unexpected things? Was it a change in policy? In general, was it within or without the control of the government's finance officers and its policymakers? A revenue variance is calculated by subtracting the earlier amount from the later amount. So budgeted is subtracted from actual, original budget is subtracted from final budget. That's how you find out what the revenue variance is. And then if it's a negative variance, it's in parentheses. It means the revenues were lower than expected. And it's not negative in the sense that it's a bad thing necessarily, but that it has a negative impact on the bottom line. It increases the size of the deficit, whereas a positive variance reduces the size of the deficit or perhaps provides a surplus. Those are revenues that are higher than expected. So you see here, you got the property tax was $679,000 less than expected actual compared with the final budget, whereas licenses and permits actually were $161,000 higher than expected in the final budget. That's a positive variance. A negative variance, a positive variance. A shortfall in expected revenues, a surplus in expected revenues. Now with expenditures, you're flipping the equation around. Now you're subtracting the more recent number from the earlier number. So budgeted minus actual, original budget minus the final budget. So a negative variance, again, higher than expected in this case, higher than expected revenues, higher than expected expenditures, I'm sorry, are going to drive the deficit, whereas lower than expected expenditures would reduce the size of the deficit. Again, remember, this is not negative and positive in a qualitative sense. It's just, the impact it has on the difference between revenues and expenditures. Underspending may not be a good thing. It may be that they were more efficient, but it may be that they didn't provide services that were really needed. And a positive variance, that's a positive variance. A negative variance, when they spent more than they were expecting, that could mean that they didn't tightly control spending, which is a bad thing, I suppose. Or it may be that there was a new need that had to be met. So that's not necessarily a bad thing. So you need to take the value judgment out of this a little bit. Negative variances are higher than expected expenditures. Positive variances are lower than expected expenditures. So public safety, you can see, was $932,000 higher in expenditures than in the final budget than in the original budget, whereas general government spending was actually $846,000 less than expected in the final budget. As I alluded to earlier, when you're looking at the budgets, you know from the CAFR where we are and how we got to that place, but how are we moving forward? Let's bring ourselves up to date from the date of the CAFR, the date of the financial statements in the CAFR to the present day, and then going forward into the future. You're going to get that kind of information out of the budget. It's going to help you understand whether finances are sustainable in the future, and if they're not, what is it the government's going to do about it? Does it have a plan in place to help you deal with it? And as with a lot of other things, budgetary information, is both indicative of financial issues and indicative of financial management issues. If a government, is routinely way off in its budget estimates, and the actual numbers end up being substantially different year after year after year, that might suggest that that government's not too good at budgeting. It's not too good at projecting its revenues and its expenditures, and that's a financial management issue that might factor into your feelings about whether that government's prospects are good. A government could have tremendous resources available to it, and if it's managed poorly, it may never be able to take advantage of them. So here's an excerpt from the City of New York's 5-year financial plan. That has the current year, the budgeted next year, and then 3 additional years looking out past that. These are the projections of revenues for the 5-year period, projections of expenditures, and then the key number you want to look at here is the difference between those. The current year, they're projecting budget balance. They've proposed a balanced budget for the next year, which in New York City they're required to do. But look at the fact that even though they're projecting or proposing a balanced budget for the coming year, the years after that still have large and growing deficits. That's a $2.5 billion, $3.1 billion, a little less than $3.1 billion. That's showing that there's still a sizable problem to deal with going out, despite the fact that they've done some things to close the gap in the coming year, as well as in the current year. Only some of that has had value toward the future year, and costs are either growing so fast or revenues growing so slow that the difference between them continues to grow in the future years. And so you're going to want to find out, well, what is the government going to do about that? How is it going to close that $2.5 billion budget gap 1 year down the road? Let's shift gears again, go back to looking at the historical information and look at ratios that measure the financial performance of government over a period. Here are several examples of those ratios. Basically, what we're looking at is the difference between revenues and expenses, or revenues and expenditures, and comparing it to aggregate expenditures to give you a sense of the margin. Not the margin of victory, but the margin. If this were a private company, you'd be talking about it as profit margin. But here we're talking more like an operating margin. Uh, the degree to which they covered their costs. If you look at this first one, revenues minus expenses divided by expenses, you obviously can do this for the governmental activities, the business type activities alone, or for the total primary government. Let's look at just the governmental activities here, because I think that's a fairly interesting number. Revenues minus expenses divided by expenses, and wow, that's a pretty sizable decrease in the net position of the governmental activities, a 13% decrease. So, financial performance doesn't look so good there. But now you need to ask why. You can't just say, hey, this is a poorly performing government. Their performance ratio was negative 13.26%. You need to understand why. Is this a recurring problem, a growing problem? Maybe it's decreasing. It's still a large number, but maybe it was much larger in recent years. Or maybe something happened in this particular year that drove that number. I'll give you an example. One very large government, when it implemented GASB Statements 43 and 45 for OPEB, decided that it was going to swallow its entire unfunded liability in 1 year rather than amortizing it over a period of up to 30 years. So they recognized a $55 billion expense in that year, which was almost as large as the total expenses of the entire government. And so, as you might imagine, they would have had an enormous financial performance negative ratio. Would have been somewhere in the range of negative 60% or negative 70%. And is that a real indication of what happened in that year? No, it's a vestige of the accounting choice they made. And so you do need, that's obviously an extreme example, but you need to be careful. There may be a one-time thing that happened there that explains that. And so that year is out of character from other years, and that's why it's important not to just look at any single year. Let's look in the governmental funds then. Basically the same ratio, but on a modified accrual basis, revenues minus expenditures divided by expenditures. And we're looking at it, in this case, for both the general fund and the special revenue fund that's reported for this government. So you have your revenues here, your expenditures here, divided by the expenditures. And, well, that looks a little better. It's still a negative number, but it's certainly better than negative 13%. And that, the difference between that and what you saw for the governmental activities may start to give you a hint of the kinds of things that explain the difference. Perhaps we're talking about depreciation there. Maybe that's what was really driving it, or something else that is a factor of the difference in the basis of accounting. Maybe it has something to do with the difference in the scope, because the governmental activities include the internal service funds. You'd need to look into it to be a little clearer as to what's going on there. For a business type activity, you might want to look at operating margin. That's one name for this ratio, where you're comparing operating revenues and operating expenses. So operating revenues minus operating expenses divided by operating expenses. Here it is for the water and sewer function for this government. And that's a supremely healthy operating margin, 64%. In fact, it may be too healthy. I get as worried about a number that large as I do of a number that negative 13%. This one worries me too. I want to know why their operating revenues are surpassing their operating expenses by so much. Now, part of the answer to that may be in looking at their non-operating revenues and non-operating expenses, and we'll look at a ratio that includes those in a moment. But you might want to understand what's going on here. Maybe they're accumulating resources for some significant investment in capital assets. It's hard to know. Or maybe they're just way overcharging, and that's an area where they ought to think about reducing their charges and providing some benefit to the customers and to the taxpayers. Looking at that same ratio for the parking facilities, on the other hand, you see that they have a negative 15% ratio. Which again, you don't want to jump to a conclusion that's bad, but in general, you expect your BTAs to cover their costs, and as happens to be the case for a lot of municipal parking operations, they don't, because the government isn't willing to charge what it actually costs to provide that service. And so it becomes something like a public good, where the government is subsidizing the cost of parking by private citizens. So here, we're going to capture the non-operating revenues and expenses as well. We're going to look at total revenues minus total expenses divided by total expenses. And, rather than going through all of those individual numbers, you can actually just go down here and look at the income or loss before contributions. For the ratio we just did, you could have looked at operating income and loss as well, rather than subtracting expenses from revenues in the numerator. So here are your operating expenses, and then you got to get those non-operating expenses from down here as well. So looking at the water and sewer operation, okay, it's not 64%, but it's still pretty high. So now we've accounted for the non-operating revenues and expenses, and they still have an operating margin that's 38% above what they needed to cover their costs. So you're going to want to look into that and find out why that's so healthy. Looking at the parking facilities, on the other hand, they look even worse. They're just looking at the operating side, it was minus 15%. Now you bring in the non-operating expenses and non-operating revenues, and they're almost 43% underneath what's required to cover their costs. And that brings us to this issue of self-sufficiency. The statement of activities is set up to provide you with net expense, net revenue information that speaks directly to whether activities are self-sufficient in terms of the amount of revenue they generate from their own activity. So when we're looking at self-sufficiency, we're asking, through the raising of grants and the charging for services, fines, fees, penalties, does an activity cover its costs, or is it dependent upon taxes and other general revenues to support it? When we're talking about governmental activities like police, education, fire, sanitation, you're basically expecting those to have a large net expense, meaning that they're heavily dependent upon taxes and other general revenues to support their costs. And that's why governments provide them, because they are not ideal private goods. They're public goods. Business type activities, on the other hand, generally are expected to be self-supporting. They essentially work off a model where they set their fees for service or for goods, at a level that's going to cover their costs. It's not always true, as we just saw with those parking facilities, but generally it's expected to be. So if we want to make a ratio out of self-sufficiency, rather than just looking at the aggregate net expense or aggregate net revenue, let's get a sense of the degree of self-sufficiency or the degree of dependence on general revenues. So you're going to need the net expense or net revenue amount, and you're going to need the expenses. If a government, and most don't, but if you happen to run into a government that allocates its indirect expenses, then you need to add these two columns together for each of the activities before subtracting them from the program revenues to get your net expense or net revenue. So here's what this ratio might look like: expenses minus net expense divided by expenses. And if you do that for police, it looks like this. So 6.6%, what does this mean? It means that the money that police activities generate on their own covers 6.6% of their costs. That's pretty small, but that's what you'd expect for police. You don't expect them to cover a significant portion. In fact, when they start to, what is it that they raise in terms of money? It's tickets, right? They're giving parking tickets and moving violation tickets, and people start to get a little mad when governments try to balance their budget by increasing the level of ticket activity, because it's almost like an indirect tax. We're not going to raise your taxes, but we're going to ticket you into bankruptcy. Let's look at a BTA now, self-sufficiency. Expenses plus if they have a net revenue, you're going to add the net revenue rather than subtract the net expense. And for the water activities, you see that their self-sufficiency, they've raised 48% more in revenue than they needed to cover their costs. Let's look at the parking just for fun. They have a net expense, so it's expenses minus net expense divided by expenses. And they're only raising 48% of what they need to cover their costs. So, less than half of the cost of parking facilities is actually paid for by the revenues that the parking facilities generate. Let's shift gears a little bit now. We've been talking about operating, and now let's take a look at the capital side of things, both from the perspective of capital spending as an important issue itself, because it relates to the replenishing the supply of infrastructure that is used to provide services, and because capital spending, especially if it's financed through borrowing, has an impact on the operating budget. In fact, even if it's financed on a pay-as-you-go basis, meaning they're raising revenue each year to pay for capital construction as it happens rather than borrowing long term, that's a priority decision. I mean, they're spending on capital rather than spending on operating. The maintenance spending, just painting and minor repairs, that's all in the operating budget. But to build a capital asset, to buy one, to extend their useful lives, or to improve upon the utility or the amount of service that can be provided through that capital asset or infrastructure asset, those are capitalized on an accrual basis. They're reported as capital assets and then depreciated over time. Of course, from a modified accrual perspective, looking at a capital projects fund in the governmental fund financial statements, maintenance and capital investment are both reported as expenditures in the year they occur, because there's no reporting of capital assets there, just the flows of current financial resources related to capital investment. Capital investment basically is financed in three ways: grants from other governments and from private sources. Pay-as-you-go, which I just defined for you, is essentially raising revenues each year to pay for capital construction as it's done. And then long-term borrowing, selling municipal bonds or some form of debt that is paid off over a period that could be from 5 to 30 years, or sometimes even longer. And from a public finance perspective, that's an acceptable thing to do, because you're matching the payment for the asset with the years in which it's going to be used, and in which the taxpayers who are going to repay that debt are benefiting from the use of that infrastructure. What are the drivers of spending on capital? Well, certainly population. The higher the population, or the more dense the population is, the greater the capital asset needs. A larger population or a more dense population is going to use roads more frequently. It's going to use subways more frequently. It's going to be using a lot more water. It's going to produce a lot more wastewater, and so investment in those capital assets the need is going to be greater. Climate. I mentioned before about freeze and thaw cycles and what that does to roadway surfaces in the way of creating potholes. and worse problems, eating away at the bed underneath the asphalt on the road. If there's substantial rains, these are things that will drive spending on capital assets. Uh, what types of services a government provides certainly is going to have a big impact on what it spends for capital projects. If it has a responsibility for roads and bridges, then it's going to have to spend money to keep those standing and in good shape. Whereas a government that doesn't have a responsibility for roads and bridges, isn't going to have to spend in that area. Certainly, what the elected and appointed officials consider to be important, what citizens consider to be important, are going to set priorities for capital spending, and then whether it's affordable or not. And that boils down to either their ability to raise year to year revenues to pay for capital investment or to pay for the debt service on borrowing that financed the capital projects, is a big issue. This is another issue, that has both quantitative and qualitative factors. Quantitatively, you're looking at this, you want to know what are they going to need to spend, can they afford it, how are they going to finance it, but it also has a qualitative aspect in, giving you a sense of of how well run the government is, how well it's managed, and therefore, all other things being equal, its prospects for the future. If they have a multi-year capital plan, that's a big plus. That means that they're at least spending some time thinking about what their needs are going to be over the near term. And if it's a longer one, like certain governments have a 10-year financial plan, that's even better. They're really, thinking ahead. Now, it may not be worth the paper it's written on. That's going to vary from government to government. But all other things being equal, if a government's doing some financial planning, both on the could be on the operating side or on the capital side, that is an indication that they might be a better run government than another government that doesn't do it. What you want to see in that plan, if they have one, is an identification of what they need to invest in capital, what the cost is going to be, which are the most important items, that if they don't have enough money to do all of them, which ones are they going to focus on, and when they're going to spend that money, how much they're going to spend, and where the money's going to come from. How are they going to find the money to finance that spending? If there's physical condition information available, that's a great thing. First of all, it indicates that they're keeping track of the condition and have a better sense than just looking at depreciation of where their investment needs are. And it's helpful to you to judge whether their priorities are the right ones, whether they're spending their money in the places you think they need to spend it. Here's an example of information I found on the state of Massachusetts, the Commonwealth of Massachusetts website. Their capital investment plan for 5 years, the current year and the 4 years that follow. And here they show the variety of types of investments in capital assets they need to make. Not surprisingly, for a state, half of it is transportation. That's something that's going to be common for states because transportation spending is such a significant portion of their infrastructure. State highways and state bridges and things like that. That plan also shows how they expect to pay for it. This portion down here in blue is what they plan to do in terms of borrowing, and then all the rest they're hoping is going to come from someone else. A big chunk from the federal government. That's probably mostly federal transportation aid. You can see the Recovery and Reinvestment Act, or ARA money, that they had for a couple of years, and which they're not going to have going forward. It looks like there's a tiny little sliver of it in here, a little bit of orange there, and then nothing in the years going on beyond that. So at this point, there's only a portion of it, maybe less than half in the last year, that they expect to pay for themselves, and they're hoping that other people are going to give them the money they need. They also have this useful information about that indicates the affordability of what they're planning to do. And here, if you look at just their existing outstanding debt related to capital projects, you can see what that debt service is as a percentage of their projected revenues. And not surprisingly, if you're just looking at existing debt, not debt that's may be issued in the future, that debt service decreases as projected revenues increase. It's a smaller percentage of the budget. However, it's not realistic that they're not going to borrow any more money to pay for capital. They're going to have to borrow some to pay for those capital investments if they're going to be made. And so they have an additional one that adds in their projected borrowing and the impact there. And you can see that they show it growing to 7.42% of projected revenues. Let's just go back a second. Without any additional borrowing, it would have dropped to 5.62%. With the planned additional borrowing, it grows to 7.42%. And so you can see it's a growing portion of their annual revenues, and that's going to bear on your judgment about whether they can afford to do what they're planning to do. And remember, this is just for a portion of what their capital needs are. If they can't get the money from someplace else for those additional capital needs, either they're not going to make that investment, which has implications of its own, or they're going to have to borrow more, which is going to drive this percentage up even faster. Here's information from the state of Florida's CAFR. They use the modified approach to report their highway system. And this information is presented as RSI. And you can see that their goal is to keep the overall rating above 80. And their maintenance rating, here it is. It stayed, relatively constant over the most recent three condition ratings. And you could obviously look back at several CAFRs and get, a 10-year trend or so to see how it's doing over the long term. It'd be interesting to see where this will be in 2012 if the recent financial difficulties have had an impact on their ability to maintain these highways and bridges. A declining or improving, physical condition is going to matter as you judge what their capital needs are going forward. They're also required to compare what was needed to be spent to maintain and preserve those assets at the projected condition level, which was a rating of 80 or better. While the resurfacing program, they are routinely underspending. Needed is much more than actual. Same with the bridge repair. They spent more than was needed in 2011, but they'd been underspending quite a bit in 3 of the 4 years prior. And then the routine maintenance, actually, their actual spending seems in most of these years, in all of these years, to be greater than needed. And that's the kind of thing I might want to look into. So why are they spending so much more on routine maintenance? Is that a substitute for more expensive repairs, in terms of resurfacing and component replacement and repairs on the bridges? They might be, making a choice, that they can continue to do some routine maintenance and try and extend it, maybe like painting. I think it's a famous thing that some governments have done is, try to paint over the rust on bridges rather than replace rusted components to try and put off that more expensive replacement capital construction as long as they can. Here's something from the state of New York's website showing the conditions of state and local highway systems. These numbers are the percent that were determined to be deficient. Their physical condition was deficient. You can see a significant improvement here on the local highways. They were nearly half of the local highways in 1994 were deemed to be deficient. And they had gotten that down as low as 37.7%, and pretty close to that 38.1% in 2007. There's an improvement for the state highways, but not as much. They were at about 1/3 of them were deficient in 1994 and 29% in 2007, but they'd actually gotten it as low as 27.3%. It's been on the rise over the last 5 years of this trend. There's also the valuable information in the note disclosure of changes in capital assets over the period. If you take this information from the current year, looking at the depreciable capital assets, you can get a sense of how old they are on average, or how close they are to needing to be replaced. And the way you do that is you divide the accumulated depreciation by the historical cost. And that gives you the percentage of the useful life that has been used up. And well, in the case of Massachusetts, it's pretty substantial. Their buildings are more than half used up. They have less than half of their useful lives left. The machinery and equipment, their useful lives on average are 2/3 used up. And for infrastructure, their average useful lives are more than 3/4 used up. Uh, if you combine this information with the information you can find in the summary of significant accounting policies about estimated useful life that they use for the purpose of depreciation, you can get a sense of how many years are left before they're going to have to make significant investments to replace those capital assets. So if you subtract that percentage depreciated number from 1 to get the remaining percentage of their useful lives, and multiply that by the estimated useful lives, it'll tell you how many years they have left. So on buildings, it looks like there are about 18 years on average left in the useful lives of those buildings. Of course, the useful lives may in fact extend beyond that, but hopefully those are reasonable estimates that they're using. Machinery and equipment, on average, they're 2 years away from having to be replaced, and the infrastructure assets are 7 years away on average, from needing to be replaced. So obviously, infrastructure and machinery and equipment are very high capital investment priorities over the near term. Really, maybe not the next couple of years. Well, it is for equipment, but within the next 10 years, they're going to be reaching, the end of the useful lives of a lot of that infrastructure, and that's a pretty significant investment that's going to need to be made. And that brings us to the end of the discussion of expense and expenditure analysis. So what have we talked about here? What have we learned? Last week, we looked at resource inflows, and this week we're looking at the thing for which those resource inflows are raised, the spending and the costs that need to be covered, and and then putting them together and comparing them to one another, the sufficiency of the inflows to cover the outflows, both on an accrual basis and a modified accrual basis. When we go to look at BTAs, where we've got some cash flow information, we're going to look at that on a cash basis as well. And we've looked at some ratios that can be constructed from the comparison of revenues to expenses and expenditures, an operating margin, if you want to call it that, or surplus deficit ratios, to get a sense of whether governments are meeting their costs, meeting their outflow needs in each year. We looked at self-sufficiency, the degree to which individual programs and activities raise sufficient revenues to cover their costs, or alternatively are dependent upon general revenues like taxes for their support. We started to touch upon the issue of efficiency. And the relationship between the inputs, the employees, and the money that's spent on the one side, and the outputs, the amount of activity, the level of service provided. How do they relate? The greater the efficiency, the more that you can provide in the way of service for a given amount of money. On the other hand, you could provide the same level of service for less money if efficiency is greater. That's a key relationship to understand as you're trying to figure out what happens in the black box of service provision. What happens to those inputs inside that black box that produces the amount of output on the other side? We looked at the major drivers of spending, labor being the biggest one, and being a factor of how many people are employed and the cost of employing them in terms of salaries and benefits and retirement costs. We looked at some non-personal costs like rent and utility and supplies, maybe even income transfers and other programs that involve payments to service providers other than employees. Basically, the bottom line here is we're trying to understand why governments spend what they spend. How much of it is under their control? Do they have any choice in what they're spending? Is this what citizens want them to spend on? Are they spending that money wisely? These are all key issues that are a part of understanding how a government's financial position is changing from year to year.